99% of traders are unprofitable because they don't know the smart money manipulations in the market and the liquidity it generates inside of the market. So in today's video, we are going to be seeing these manipulations step by step and try to understand how to put our position inside of the market. So let's start. So now let's try to understand what does the market wants to do. After every huge buy or sell swings, the price will be having a range process. I hope that everyone knows what is range. If you don't know, it is basically the price goes sideways. And many people do not understand why the market does this. The actual purpose is they inducing the opposite side of each market. So based on smart money basics, I know that many people from many different kind of reasons opening buy and short positions. Let's try to analyze inside of the range. Some of the traders think like they have already made the higher high and a lower high. So their expectancy is going to be for a higher high. What happens? They open buy positions at this level. And some of the traders will see this double top and think like it is a resistance level and they will be placing their short positions here. And also some of the traders maybe have seen some small order block and opened their long position at this level. But as a smart money trader, the thing that I know is the price is going to be hitting our liquidity at the bottom, swing low, and the swing high later on. That my expectancy is actually. So for putting my positions, so now I see that the price has just hit the swing low. Now my expectancy is going to be hitting the swing high. So first of all, I need to see some price action from the market to put my long position inside. So what happens later on? So the price makes a kind of action like this. So what should I understand from this? First of all, I see my internal market structure shifting. Now my second expectancy is going to be supply area. So here's our supply area. The reason of this liquidation was just to create side left liquidity so the price could get better areas in their orders. So we should know that the smart money has more than any participant in this market. So after the market structure shift, price makes a mitigation phase. It actually going back to the demand area. The reason of this, because if smart money are buying, they need to create a perceived supply of the asset they're trading. Now can they use that liquidity by initiate their buy orders? So basically, to sum up, we had a swing low and a swing high liquidity. We have generated a liquidity in the middle of the swing. After the sell side has taken, I'm seeing an internal market structure shifting. Now I know that the buyers are coming inside of the market, and then when the price comes back inside of the supply area, I will be putting my buy order at this point, just like this. So here's my last UK 100 trade, and it is exactly the same trade, the example that I have just shown you. So first of all, we need to identify our external highs and external lows. If you don't know how to identify the external highs and external lows, it is basically starts from knowing the lower lows and higher highs. Lower high, higher high, lower high. After the aggressive move, this little pullback tells me that this is my sell side liquidity. The trade was on Wednesday, and I'm trying to analyze the Mondays and Tuesday price action. So all I'm seeing is that after generating the buy side liquidity, the price bounced from the Fibonacci areas till exactly the same area with the buy side liquidity. So when Wednesday comes, I'm seeing that the buy side liquidity is being swept. Now, I know that there's no liquidity downside, and my expectancy is having an internal market structure shifting and a pullback inside of my supply area. Now, let's try to see what has just happened. My liquidity is being taken. I have seen my internal market structure shifting, and here, as you can see, there is one more inducement, one more little liquidity taken. So this is my confirmation actually for getting inside of the market. It was a little bit aggressive entry. I could have waited till the buyers pushing this old bearish candle, but I was so sure that the price was going to be hitting our Asia high inside of my London session. First of all, every session's lows and highs are including very high liquidity, and after every huge buy or sell swings, we are generating a accumulation in the market. I'm placing my lows and highs. I'm identifying my external highs and external lows. And when the session has started, I'm waiting for my internal market structure shifting and attaching to my demand area. Additionally, by leaving some few more pips than the last low, you can enter a high risk reward ratio trade, just like this. So the key in this game is waiting. When I drove this trade, there wasn't even an internal market structure shifting. I was just waiting for it to open my long position because I knew that the liquidity was upside. Then the price did what I wanted to see, and the trade, which comes exactly, do your analysis and wait for the market. If it doesn't do the same things that you are expecting to, do not enter that trade. If you don't get this aha moment, in most of the cases you are going to be losing trades. So I wanted to keep this video short and give you the most information at this small of time. If you like the video, please subscribe and leave a like. And if you want me to talk about more of the things, you can write down.